Morning, everybody. I think we're going to go ahead and get started. We've got about 26 people on the line, and I think that's about what we were expecting. So thank you, everybody, for taking some time out of your day to meet with us. Our webinar is on the COVID-19 and the impact on the overall loan loss calculation. So we're going to go through a number of different items momentarily. So just some general housekeeping items. Just making sure that you can hear us, making sure that your speakers and earphones are on, as well as ensuring that if you do have any questions, please use the chat and all panelists, and that will ensure that we are able to receive any questions that you may have and be able to hopefully address any questions that you may have. If we do not have a chance to get to your questions, we will reach out to you subsequent to this webinar. So with that being said, I probably should do an introduction as to who I am as I'm talking. I'm Aaron Kofira. I'm a partner in the Professional Excellence Division here at the Bonadio Group. My responsibilities are mainly surrounding a lot of the technical issues and technical guidance that come out and applying them to financial institutions, as well as going through the second partner review on a number of financial institution reports that get issued by the firm. So that is kind of my role and responsibility here. And I'm joined by Jamie Card this morning as well, and I'm sure pretty much everybody on this call knows Jamie because she's a well-known person around these neck of the woods, so she does not need an introduction at all. That being said, she will give you one. From an agenda perspective, we're going to do our introductions. We're going to go through some interagency updates. We're going to go through FASB updates and kind of talk about what we're seeing in the general landscape of things there. And then we'll talk about recent quarterly files from an SEC perspective, kind of what a lot of public companies are reporting, and then kind of give an overview as to where we think that the industry is going from as a result of COVID-19 and kind of just lay some just more anecdotal information and more of our opinions and thoughts as to where we see the industry shaking out on that. And with that, with all good webinars, especially when I'm talking, they slap up a disclaimer that basically says my opinions are my own and don't represent the views of the firm or my other partners. So with that in mind, I will go ahead and also turn it over to Jamie. The disclaimer also applies to you as well. So heads up. So.
That is correct. As Aaron mentioned, I'm Jamie Card. I'm a partner and financial institutions team leader here at the Bonadio Group. And obviously Aaron works with us in the Professional Excellence Division, and he's also a financial institution partner. So we thought we'd start out today discussing some interagency guidance that was issued back in early May. Although these two things don't specifically address COVID, they are impactful to the allowance for loan losses, so we thought it was relevant for us to discuss them today. So the first one we'll discuss is the allowance for credit allowances, for credit losses rather, and it was exposed in October of 2019. The comment period related to this ended in December of 2019, and as I just mentioned, the final document was issued in May 8th. So how the final document was laid out, they did indicate the comments that were received and how they were going to be disposed of and or incorporated into the final guidance. So this is applicable upon the adoption of the CECL standard. So generally speaking, that's either fiscal year 2020 or fiscal year 2023. And this does supersede any prior applicable regulatory or interagency guidance. And I think a common theme throughout this document, as well as the next one that I'm going to discuss, everything is based on size and complexity of the institution. I would recommend reading this because it is really a good roadmap for the adoption of the CECL standard. It does provide guidance on policy, process, as well as governance standards. 40 pages long, so it's not a lengthy document to read. So a couple key takeaways on this document for me was as it relates to the debt securities, it did indicate that there is an expectation for a Q factor as it relates only to the held to maturity securities. So that is explicitly included within the guidance, as the available for sale securities are measured at a discounted cash flow basis. As it relates to the estimated credit losses on off-balance sheet items, and this is actually one that I've received questions about over the past year, the FFIEC is considering changing the classification on the call reports for banks to the provision for credit losses rather than the current classification as non-interest income, because that classification is inconsistent with the newly issued FASB standard. As it relates to call reports for credit unions, it's not an issue because the classification is already there. Another thing this reminded me of was, as it relates to accrued interest receivable, that is scoped into the standard, and you must make elections as it relates to the treatment of accrued interest receivable on the date of adoption, and it's by class of financing receivable or major security type. And then they did explicitly discuss reasonableness tests as part of the allowance for credit losses process, and they kept on referring to the actual to estimate, look back, and they said that it's not necessarily required, however, it is recommended, and that you should be looking at ratios that are best suited for your financial institution. And then lastly, as part of the validation process of the allowance for credit losses, they did point out that if you look to use an external auditor for this service, that you just need to be cognizant that if you have SEC standards applicable to you as an institution, that could impair their independence. So again, this is relevant as you continue to move forward with the adoption of the CECL standard, and we thought it was important to discuss.
So it seems to me like that really just brought a lot of that interagency guidance and made it consistent with what we already kind of knew based on what the FASB put out with CECL. And I know, because it sounds like a lot of things that you're talking about that are covered in this interagency are also covered in the ASUs that speak to CECL. Like I think last year they put out an ASU that specifically addressed that accrued interest component.
Yep.
And it sounds like that's all now being captured and brought together, which makes a lot of sense from their perspective to line it up with the standards, if you will.
And they indicated in all instances that obviously the examiner's handbooks would also be updated to reflect this revised guidance as well, which again has been a concern of everybody.
Which is good, because we don't want 5 different standards that follow. We it's complicated enough with one. We need 3 books to get everything going.
So the next one is guidance on credit risk review systems, and again, this was exposed in October 2019. Comment period ended in December of 2019. Final document issued in May 2020. And again, this also commented on the comments that were received and how they were disposed of as it relates to the issuance of the final guidance. So what this one is doing is previously the 2006 Interagency Policy Statement on the Allowance for Loan Losses, which is the superseded guidance that we just spoke about, there was an attachment 1 that really spoke to the credit risk review process, and this is the guidance that supersedes that. And again, a common theme throughout this one was, size and complexity of organization, because there were a lot of commenters that were, inquiring about either the small banks or credit unions and how they can, apply the guidance successfully for when the examiners come in to examine them. And again, this one is a real quick read. This one's only 12 pages long. I think it's well worth the time to look at it. And again, it's like the full scope of, the process as to what you should be doing to have an effective credit risk review process. So what the agencies focused on within this guidance was sound practices, what was appropriate for institutions of differing sizes, and what additional factors in the proposed guidance could help credit risk review achieve a sufficient degree of independence. It does, in the document, provide a clarity on what the role of credit risk review function is, and that was defined as the prompt identification of loans with credit weaknesses and the validation and adjustment of ratings. It also clarified that the credit risk review function is not intended to be performed by the institution's internal audit function. It did indicate, however, that their work could be leveraged. For example, it specifically indicated that the loan documentation review process, which, again, this guidance recommended, was not part of the credit risk review function. The final guidance did retain references to evaluating workout plans. Since such an assessment is a strategy that's within the scope of the credit review process, there were a lot of questions from commenters surrounding this process. It also discussed the inclusion of non-lending activities. And again, this looks back to size and complexity. So should the credit risk review function be reviewing the credit risk of any investment securities that you have in your portfolio? Again, looking back to the size and complexity of your investment securities as well as your loan portfolio. As it relates to frequency, They said that it should be based on your institution's specific circumstances while continuing to operate in a sound and effective manner, which they defined as typically an annual process. They also pointed out that when opposing opinions arise as it relates to risk ratings, that the lower rating should prevail unless there is information or support to support that higher risk rating. And then lastly, that the guidance was designed to apply to all loans and portfolios, including retail, because there were a lot of comments and questions surrounding technology and its application, where you're doing those, I hate to say, robo loans that are based on certain fact patterns and so forth, and, whether or not you should be scoping in some of these smaller, more common dollar loans. So the guidance was provided for this. So again, we know that this doesn't specifically speak to COVID per se, but we thought that it was timely and relevant to share with you and good information for you to review.
Yeah, I think it's good that they're actually providing some relief for some of these smaller institutions. I think it's always been what applies to, like, we'll pick on Wells Fargo because they seem to be always in trouble for something. But I think it's good to see that they're finally starting to realize that there's a lot of number of institutions that service a lot of people throughout the country in a lot of different areas that need this additional guidance, which is good to see. Because I know, which is a good segue into my FASB issue, because as everybody is probably aware, a lot of what's written is really written for major SEC reporting companies, and so when smaller entities go to apply it, it's oftentimes very difficult and cumbersome to apply it, which is why they have the PCC group. I don't want to get into tangents on the FASB stuff. I can talk all day, and we don't want to talk about that all day. Nobody likes that except for me. So, but it's good to see that there's a little bit of common sense, if you will, applied to this stuff for a change. That being said, I will talk a little bit briefly about what's going on at the FASB as the main standard setter. They're seeing a lot of, if you follow the FASB, a lot of deferrals around leases and revenue recognition very late in the game, which is interesting because most companies had already gone through and implemented it, but they're doing a lot of deferrals. Unfortunately, they're not deferring the CECL standard, which is interesting, but that's just the world that we're living in. They're just not deferring one that would probably help everybody on this call. One thing that they did take up recently was the question on COVID-19 loans that are being given or granted like a loan payment holiday. So if you're part of an institution and you give a 3-month loan payment holiday and you don't require payments on that loan, how are you going to go ahead and treat interest that normally would be associated with that loan? And the FASB took this up not to issue a standard ASU, but more as a technical inquiry. So what is the difference? A standard basically will give you an answer and a roadmap as to how to do it. The technical inquiry is really just more of their thoughts and recommendations on a specific, very narrow question. And so ultimately it's non-authoritative, but it does provide a little bit of insight as to how they're interpreting the various guidance out there. The one important thing to note out there is for any of the lenders that are providing these loan payment holidays under the COVID-19 umbrella, they're not considered a TDR per se, and that's as of right now, because right now we're working in this framework of we've got a 3-month window, we may get another 3-month window, but what happens after that, it's probably going to default back to the TDR guidance. But for right now, until we have further clarity from the FASB, this is where we're at. So there's 2 different views on the treatment of these loans. The first view is you would continue to be recognizing interest income on these specific loans based on the new effective interest rate that you're calculating. So that's view 1. If we jump over to view 2, view 2 is basically upon the overall modification of this, there is no interest income on that deferral period, and you would pick up interest income subsequent once you start remaking those payments after the individual loan payment holiday. That being said, but really what it really all comes down to is the overall documentation and the agreement to what the institution and the customer signed and what they agreed to as part of that modification. So that is something that's very important to make sure that you have at your institution are these specific agreements as to laying out what the overall underlying terms are. Because at the end of the day, the FASB came out and said, we don't know. We like either approach. As long as you go through it and you do it, the overall conclusion is that you can either do view 1, view 2, but you have to be consistent. You have to ensure that you're being consistently applying the loan to the entire portfolio. You can't pick and choose as to which one. So as long as you're consistent and you're disclosing that overall the policy that you've implemented, the FASB would not take exception to how you're doing it.
And I think the important thing that we've really been discussing with clients is that to make sure that whatever your agreement reflects, which Aaron was just alluding to, drives the accounting, to make sure that your system is capturing that accounting appropriately. I know everyone I've talked to has said that their system has the ability to do it, but we obviously recommend testing it to ensure that the actual, recording of it is as intended. So just a reminder to be auditing those as you go along.
Right, because that's something that will obviously, Jamie and her team will, and we as a firm will definitely look at, and we don't want to have a large adjustment at the end of the year for something like this. So that definitely is key to make sure, because it does sound like the systems can do it. So that's definitely a good thing, because I think at the beginning of this whole process, there was a lot of concern that maybe the systems wouldn't be able to do this. It was going to become a very manual and cumbersome project, and it sounds like maybe that's definitely not the case. So that's a good thing. Turning our attention a little bit now to our overall 10Q filings, and not just our 10Q filings, the mass group of Q filings, and some of this is actually also applicable to non-financial institutions. We're seeing it across the board on a lot of discussions. A lot of heavy emphasis on COVID-19. What's the impact on business? What's the impact? A lot of it's in the MD&A or risk factors. So is there a workforce disruption? What is the overall state of the economy where the institution is or the business? What is the loan portfolio looking like? Is it heavy in loans that are potentially at risk, such as like restaurant portfolios, just those sort of things? So heavy discussion over COVID-19 and the overall impact. Now, interestingly enough, when all of this pandemic really came to a head was really middle to late March. So there really was not a lot of significant time for financial institutions as well as other corporations to really react to this. So what you're seeing out there is there is SEC guidance that kind of has laid out a significant number of questions and concerns to consider as part of drafting MD&A, as part of drafting risk factors. And also, it's really surrounding the main point of this is being as transparent as possible within the financial statements. It's not just talking in MD&A, but when we talk about transparency, we're talking about how many of those PPP loans have you deferred? What is your policy on that deferral? And to a large extent, I think we're seeing in a lot of filings, they're disclosing the number of loans as well as the dollar amount of the loans. So there is potential to see what the overall impact is from a deferral perspective. There are certain institutions that have gone ahead and changed or modified their quantitative disclosures as a result of that. And again, I think that is obviously something that would be disclosed and talked about not only in MD&A but also in the risk factors throughout the document as well. It's definitely a major hit.
I think for the Qs that were just filed, I think some of the important things to point out also are the footnotes. There was some disclosure, right? Because obviously that's the events that have occurred. Subsequent event disclosures, like you were alluding to about, the production related to PPP, the number of deferrals and so forth. I did see some capital disclosures as it relates to the lines that are available, as it relates to pledging those loans. A lot of citations as it relates to any sort of interagency guidance like that March guidance that was issued as it related to the accounting, and not calling them TDRs and so forth when they're deferring. And then, as Aaron said, the robust disclosure was included in the MD&A, and that's where you were looking at, industry segmentation of the loan portfolio and where the most risk was deemed to be, because again, not much was recorded at 3/31. That's more forward-looking to say, hey, this exposure is there, but we have yet, to quantify.
I don't know, and I think that's a good segue again into the next part as to what we're going to see. And I think we're expecting to see maybe some more modified loans, maybe not Q3, Q4. I think it depends on what your loan portfolio looks like. If you're heavy into commercial, there may be some more modifications subsequent to this 6-month window being up, or depending if you're not giving that or granting that, whatever the case may be.
there may be some more modification. And I think, again, that overall disclosure and the expansion and just ensuring that you have a good handle over what that portfolio looks like and what those potential modifications look like is going to definitely be important. Not just, it's also important to know that this isn't just something that's going to impact SEC filers. This is also going to impact if you have a 12/31 year end, because your disclosures are changing and are probably going to be influenced to a certain extent if the FASB does look at any of this information based on what's happening in the SEC world. So it's definitely something to consider and to keep thinking about as you go down this path of with the modifications, as well as any COVID-19 updates, if there's information that you know about or that you can foresee. Obviously, I think the Finger Lakes region where I live is actually in phase 3, and I don't know if Central New York's in phase 3 yet or not. It's still phase 2. So we're starting to look. So I think there might be a little bit of easing to where that might be something that is captured or reflected in the overall disclosures. I can't remember what the capital region is either. I think they might be 2 as well. So it's definitely something to keep an eye on, because that definitely impacts not just the overall disclosures, but it also impacts the top line and the overall your revenues and that sort of thing, because it's definitely going to have a major.
I think for fiscal 6/30 year ends, the disclosures will be more disaggregated and similar to some of the disclosures that you saw in the MD&A of the SEC filers for 3/31. Breaking out, these, how many PPP loans were made, and obviously indicating that they're guaranteed, and then how many deferrals there were, and then further segmentation, I think, of the portfolio. And then for 12/31, I think that there'll be even more disaggregation, because by that time we'll be through 2-3 month deferrals if they are granted, and then we'll actually see what the performance are of those loans and whether or not they start aging at that point in time, in addition to what they were prior to any of the modifications.
That's a good point. I think a lot of this is tricky because we're learning so much as every day goes by. I think where we sit today is much different than where we sit. What we know today versus is much different than what we knew a month or even a week or 2 weeks ago, for that matter. And I think the accounting regulators, as well as the SEC, they're trying to stay up on it as fast as they can, but you have to recognize that they're under the same restrictions that we are. They can't hold their board meetings as effectively as they may have been able to. So they're kind of running a little bit behind as well. Things are just taking a lot longer when it comes to accounting guidance, disclosures, examples, that sort of thing, just because of the state of affairs of where we are. So I think it's definitely something to keep your eye on. I think also from a loan loss perspective, or the allowance perspective, obviously we touched on the modified loans having a major impact in the next second half of the year, and then obviously the changing of the factors. I think that's going to be something that it'll be interesting to see how that evolves, not only in the SEC world. That's going to be interesting over the next 6 months, because right now it's hard to predict where we're going to be. I mean, hopefully everything will start to ease and we'll get back to the new normal, if you will. But I think right now it's something that we all have to consider as we go through adjusting our fiscal 6/30s, and it's something that our 12/31 year-end clients should also start thinking about too, is which factors really need to be impacted, as well as which types of loan pools may have a larger hit than maybe in the past. We looked at the decline in the top line growth. Obviously, interest rates are going down. A lot of people are refinancing, so I think that's going to put pressure on all financial institutions, because now where we were in January is definitely a different place than where we are now. So it definitely puts a little bit more pressure on everybody. And then obviously long term, I think there's the increased potential for defaults. And I don't know, on the residential side, we might not see that for this year, but maybe bleeding in a little bit to Q1 of 2021 from a calendar perspective.
And I think too, we were chit-chatting earlier, that the timing and receipt of the fees associated with the origination of payroll protection loans is obviously not consistent with what it was a month ago, since the new guidance has been issued. So I think that will be impactful to institutions that were anticipating having the forgiveness in Q3 calendar year, that may be obviously deferred now. And I think that there was some thought process that, if you're picking up some extra income, is there extra provisioning that can be done at that point in time, to, keep your earnings, in line. But that's just something else to think about, is the timing and receipt of that income and the modifications associated with some of those changes with the terms to those loans.
Yeah, I think ultimately, from a SEC reporting perspective, just disclosing all that and being as transparent as possible is, I think, the main message. At least that's what the SEC has obviously been pushing out, that they want to make sure that everybody knows what's going on. But again, we're all locked in as to, we only know what we know right now. So for all intents and purposes, everything can change in the blink of an eye, right? When we saw that in Q1. I think another thing to look at too is on the long-term side of this. Once we do start thinking about CECL and start looking at implementing it, how in the world do you predict something like this happening on a go-forward basis? That's very, very, very difficult. And so it's going to be very interesting to see, in my mind, if the FASB does put something out there, for at least some guardrails or some thoughts as to what is the best way to predict a pandemic. I wish I would. I think we all wish we knew how to do that. But it's going to be interesting. It's definitely going to be something interesting to see how it all shakes out in the future.
So if nobody has any questions for us right now, we did just want to let you know that we do have a roundtable coming up. I think you know that historically we were doing CECL roundtables. And in lieu of that, and given what's going on as it relates to the PPP loans, we thought it would be appropriate to hold a roundtable as it relates to that, with any questions, concerns, operational issues. Again, since that seems to be a moving target at all times, and that's coming up on June 25th at 2 p.m. So we will have a questionnaire going out ahead of time to solicit for some questions as to what you would be interested in talking about, and then we can respond to live questions as well during that session.
Excellent. Okay.
Well, thank you. If nobody has any questions, you can always email us, but otherwise, thanks and have a good day.
Thank you.